Hello and welcome to the Investing Edge. We are back after a gap and very excited to continue the conversation around the science of wealth management. I'm Sumaira Abdi and joining me as always is Feroze Azeez, Deputy CEO of Anand Private Wealth Management, and Ankur Prakash, who's an HNI investor and whose investing journey goes back 17 years. Gentlemen, hello and welcome and thanks very much for joining in. 2020 has been a roller coaster and almost no investor or portfolio has escaped unhurt. So what happens to your investment strategy, which was hit in the face with a global pandemic? Feroze, the balance has been disrupted. There's no two questions about it. How do investors now bring this balance back into their portfolios?
See, the balance has been disrupted for those who didn't have a strategy in place. Point one, I think the key takeaway from the current pandemic is markets are going to be unpredictable, and that's a reiteration. The second thing which gets reiterated is economy and the markets could be dispersing, and there could be a dichotomy. All these are attributes which the market has exhibited in the past, and it again exhibited now. The reasons could be different at different points in time, but it will find itself some reason or the other. So point one is the disruption in people's portfolios is massive if they didn't have a plan in place, an asset allocation in place, a clear filter mechanism in terms of product, and lastly, if their understanding of what risk they took, and if they're not stress tested their portfolios, there has been disruption. Now, to bring it back to shape, I think one is if you don't have a strategy, have one. Second is, if you have a strategy, look at the asset allocation again with the current scheme of things and superimpose what the current environment has for us on the portfolio and begin again.
All right, so basically what you're saying is that a strategy not just maximizes your returns, but puts an investor in a better place to withstand shocks and actually, recover from that. Ankur, let me come to you. How has your portfolio weathered the vagaries of 2020 and what has been your learning so far?
Yeah, Sumaira, see, like in any business, you need to have a strategy, execute that strategy, and have patience that your execution is going to result into the long-term benefits as creation of the wealth. So I have been as you said, I've been investing for more than 20 years. For the last 8 years, I have been with Anand and Feroze and his team, specifically people like Kedar, but they have been helping me to create the right strategy. So as you said, there are no two questions about that we are going through a turmoil, but if we have the strategy and we believe that we have the right strategy, we have to stick to it and make sure that we create long-term wealth. And that is what we have been doing.
All right. Well, the thing I'm hearing the most is plan, plan, plan. Feroze, almost every investor has their favorites, their biases when it comes to asset classes. And generally, Indian portfolios are overweight gold and real estate, right? So how do you get people to actually make realistic allocations which can optimize their returns?
I think the first thing I would like to say on this topic is don't fall in love with an asset. Assets are means to achieve an end. So achieve an end, by which I mean have objectives which are clearly defined, not just return objectives, risk objectives, transmission objectives. Attach yourself to those objectives. If you attach yourself to objectives, that's when you can create detachment from assets. So that's point one. Point two, when it comes to gold and real estate, we as Indians have come up in an environment of survival of the fittest. So our affinity by design has to be towards things which are tangible, by which I mean you can touch and feel, like gold and real estate have a certain degree of tangibility associated with them. So tangibility, to my mind, in the new world should be defined as access to the value. Like real estate, if I know my house is worth an X crores, if I can't access the value the next day, then it is not so tangible. So be conscious that tangibility is not an attribute which you should fall in love with. Third, make sure that your asset allocation comprises of 3 assets or 2 assets at a point in time, by which I mean not all assets are good all the time. Like 5 years back at Anand Rathi, we decided that real estate is an asset, very clearly showing signs of deterioration. So we closed down a real estate fund and you acted upon it. So because there was no attachment to an asset being an organization, but individuals find it difficult to action the data which they see. So the third point I'm making is don't always own all assets. There are periods where a very good performing asset will go through a trough, which could be elongated periods. If you stuck to them for long periods of time, there'll be value destruction. So the third point is not all assets at all the time also. So these are the 3 things if you kept in mind. I think being more pragmatic, more data-driven on asset allocation will only be possible if these points are not ignored.
Okay, Feroze, I have a follow-up over here. It's interesting that you say not every asset at every point in time. Isn't that akin to timing the market, because you're essentially trying to time your entry and exit from an asset class, a product, an asset class? Basically, the thing is that you're trying to time it, right?
Okay, now let me clarify. How is this different from timing? Timing is, now if you, in your strategy, let's assume you have 50% equity, 50% debt. That's your strategy. The next step, that's asset allocation. The next step comes the fact of implementation. Now, if you've decided 50 for equity, 50 for debt, if you kept this 50 waiting for a certain market level, that phenomena is called strategy, is called timing. So asset allocation is at a strategy level, timing is at an implementation level. If I've set aside some money for it, don't wait for a particular price perpetually to get that price. If you're out of it, then you're out of it for long periods of time. So that's the difference. There is a line between timing and having your strategy and the asset allocation process. Once you've chosen your asset allocation, don't wait for specific price points to implement your strategy. That's the distinction, a thin distinction between formulating an asset allocation according to all the data and then timing to get in at a specific price, which sometimes becomes very detrimental to the portfolio's performance.
Yeah, Feroze, listening to you, you're like a surgeon preparing for surgery, right? Okay, Ankur, you know what? There is nothing quite like the power of hindsight, right? So for everybody who's watching, they're looking to learn from experiences or from mistakes of others. Why don't you do us a favor? Tell us where in your investment journey have you gone wrong and what is it that you've learned from it?
So, Sumaira, I have been investing for over 20 years now, and the last 8 years have been with Anand Rathi. The one thing that I would definitely say that I have learned over a period of 2 decades of investing is that one should never try to time the market and be a little bit patient. So look, take the example of today, right? Many people might be thinking, many investors might be thinking, okay, let me wait till a certain Nifty levels, then I'll take 80% of my portfolio and invest in that certain Nifty level, so that as the market goes up, obviously my portfolio is going to grow. But that is not the right strategy, because it might happen, it might not happen. So you have to formulate the strategy, keeping in mind your objectives, what your objectives are, whether they are short-term, medium-term, and long-term objectives. And based on those objectives, the strategy implementation has to happen. And that is what one should be focusing on, not timing the market, not being impatient that, oh, I lost X amount, now let me try to recover that X amount in the next couple of weeks. Those are the things that are going to be really going to toss the strategy out of the park and result in long-term wealth destruction rather than wealth creation.
Yeah, so you can either choose, right? Patience or panic. It's your call. Okay, Feroze, one thing with assets is that the winners keep changing. They keep rotating, right? And what happens very often is that retail investors end up catching only the tailwind, right? So how can investors stay ahead? You spoke earlier about, how well ahead of time you realized that there wasn't much value left in real estate. So you advise people to exit. How do retail investors, get this knowledge or get this kind of strategy in place?
I think your asset allocation can be driven by what valuations are you buying that asset at. See, for HNI, having a wealth advisor by his side could be of some assistance to answer that question, because the wealth advisor will collate all the data and try and infer something out of it, and then help you manage your asset allocation, maybe change it in a certain situation. But for a retail investor, make sure that you have your thumb rules in place, especially when it comes to equity. Okay, valuations are a key driver in the long run. If your objective is long-term wealth creation, which I think most of us as Indians forget to focus on, retirement is never there on the cards for several retail investors. So coming back to the point of equity, have a thumb rule of at least a valuation to begin with. Then you know that you're not buying something very expensive. So now, for example, if Nifty is at an X level today, Nifty's last year earnings are 406 rupees. You should know this. If you have anything to do with equity, you need to know what the largest index in the country earned last year, 406. 10,500 could be the level approximately. Then you're speaking about 10,500 divided by 406, which is your price to earning multiple for the last year. So having a sense of that is very critical to be ahead of the curve. And it doesn't mean that any time it shoots a certain threshold, you will have to make changes, but being aware of what price at which you're buying that asset, so that you could do a relative comparison over years and decades to get a sense of where on the scale are you, could be a good input to formulate an asset allocation and avoid tail risks or extreme risks, and not be the last man having been caught on the wrong foot.
All right, you know what? Let's take a break. We're going to be right back. On the other side, we're going to tell you how you can find out whether or not your advisor is suggesting the right asset allocation. And you're going to be surprised. There's some very, very surprising insights lined up next. Stay tuned. Welcome back to Investing Edge. With me is Feroze Azeez, Deputy CEO of Anand Rathi Private Wealth Management, and Ankur Prakash, who's an HNI investor who's been doing this for 17 years. So you've spoken about asset allocation, but Feroze, the thing we want to know now is how investors should judge whether their advisor is doing justice to the asset allocation.
I think if you have to figure out whether your asset allocation has been right, and your advisor is advising you right. For example, in the current situation, over the last 5 years, real estate, there was writing on the wall. Even the RBI governor, then RBI governor, very categorically said that real estate is in a bubble. If your advisor gave you anything to do with a real estate fund, a real estate entity, or brokered a deal of buying you real estate, that's a sign of caution. Because data was so clear that you really should look away to not see this coming. So there will be instances when the advisor would give you an asset allocation which is very contrary to what data throws up. If the RBI governor went on record saying that real estate is on a bubble, and your advisor is giving you a product which is a real estate fund, and in turn, then you automatically realize there is some vested interest for having recommended. Now, quite a few wealth managers or wealth management firms set up real estate REITs, which I found very surprising. Just because the client wants to buy an apartment, you just don't try and broker the deal instead of stopping him. So asset allocation being right can be very easily thrown up when you see large pockets of specific asset underperformance, and it was clear that you shouldn't have been there, but your advisor has made you be in it. or not advised you to get out of it well within time. Because you have to, when it comes to asset allocation, like we discussed, Sumera, there's a thin line between timing and doing asset allocation. Asset allocation is trying to look at data and then formulating an opinion and then deciding what portion of your money should go into which asset. So I just gave you one illustration to figure out whether there is enough work being done, data-backed work being done to give you a right asset allocation.
Yeah, wow, you really don't like real estate, do you, Feroze? Okay, we get the point. But tell me one thing, once you've decided on the assets that are going to be part of your portfolio, how much of asset allocation is also deciding, the diversification within that asset class, and how much is too much? Because, I mean, I've seen investor portfolios which are very, very wieldy.
Correct. See, once you decide your asset allocation, it's very, very critical. You or your advisor, one of them at least, will have to make a check whether this asset allocation is to your risk appetite. How do you do that? You can test various outcomes this asset allocation would have got in the past. Like when we recommend, let's assume a 65 equity, 35 debt to the financial assets or the financial balance sheet of a client, we test it for the last 20 years and see what kind of dispersion you could have had from the expected return and find out the risk numerically. So that's the most important thing. Then comes the diversity in terms of what product classes you choose, and in those product classes, what product you choose. So there are two more very critical steps. After you've got your asset allocation right, you will have to find out what product classes you don't get into. For example, if you've chosen equity, there are 5 ways you can participate in equity. You can participate in listed equity directly by buying stocks for your client or yourself. You can buy mutual funds, you can buy PMSs, you can buy alternate investment funds, and you can also buy private equity. These are all representations of equity as an asset class. So which are the products which you shouldn't be doing has to be clearly thought out. So we, 8 years back, chose mutual funds to be the best platform to participate in equity. So to answer your pointed question, Sumera, after you've chosen the asset allocation, the next step is product class choice, and then the specific products choice. All these 3 need to go fairly right for us to be on the right track.
All right, and Ankur, the last word is always to the investor. So tell us what addition to your portfolio has benefited you the most, and which product, so to say, has been the most destructive in your view?
Well, Sumera, in God we trust, rest everybody else has to bring numbers. So I'll give you some numbers. Last 5 years horizon, if you see, Nifty has been minus 2% IRR, and company debentures, which we commonly call as structures, which are part of my portfolio, thanks to Anand Rathi, I have seen plus 12% IRR in that same time horizon. So that clearly is an alpha of 14%, which is considering where we are and considering the volatility that is there in the market today, is quite a task to achieve. So I think the strategy that has to be devised along with your wealth manager has to have products like these to make sure that they help you during these times of volatility, so that your overall portfolio is still on the positive side when there is mayhem across all the corners of the market.
Yeah, and isn't that the holy grail? Ankur, Feroze, thanks very much for joining in and for sharing your thoughts and insights. As we wind down on Investing Edge, we thought it'll be a great idea to leave you with some smart analysis on mutual funds. So here is Chirag Muni, Associate Director at Anand Rathi Private Wealth Management, telling us why Kotak Standard Multi-Cap Fund makes the cut for them. Thanks for watching.
So thanks, Sumera. Like you rightly said, we are going to analyze the Kotak Standard Multi-Cap Fund today. As the name suggests, it is a multi-cap fund as defined by SEBI, which means that the fund manager doesn't have any restrictions while selecting stocks as far as the market cap allocation is concerned. The Kotak Standard Multi-Cap Fund has been in existence since September 2009, so it has a long track record. it is one of the largest AUM in its category, about 25,984 crores. It is being managed by Harsha Upadhyay, who is the fund manager of the fund, and he's been managing this fund since 2012. He has a unique style of picking up both growth and value stocks in his portfolio. Currently, the portfolio has about 55 stocks, which is very well diversified across 9 or 10 sectors. It's generally been large cap bias in the last few years. So currently, it's about 75% in large cap, in mid and small cap. Now, we have analyzed this fund across various parameters as per the Anurati ranking methodology, where we look at the performance, which is on a rolling return basis. We look at the risk, which is the standard deviation of the fund. We look at the consistency of alpha generation of the fund, which means the standard deviation of the alpha. We also look at what is the valuation of the fund going in the future. We look at something called as the return potential of the fund in future. So when I look at all of these parameters, this clearly stands out as a fund, and we rate it as a 5-star fund. Just to give you a perspective, anyone who had invested in this fund since inception, let's say a 10 lakh rupee investment, would have turned into 33.4 lakhs as of June 30th. And during this, which is a return of about 11.74% per annum. And at the same time, if somebody had invested in Nifty, it would have turned from 10 lakhs to 24.7 lakhs. So an additional 8.7 lakhs alpha, which is consistently generated in this fund. And even if you look from a risk perspective, the 3-year standard deviation of the fund is about 20.74. And if you compare it to Nifty, also it's at 20.8, whereas this category average is about 21%, which means the risk is less, the return is consistent, and the alpha is consistent. So definitely a 5-star fund from Anand Rathi ranking methodology.